What is going on, investors? Back again, another stock analysis, again by request. If you have a stock that you'd like for me to cover here on the channel, leave me a comment below. I'll get to it as quickly as I possibly can. Today, we're taking a look at Snap Incorporated, otherwise known as Snapchat. Ticker symbol SNAP. So as you can see here, man, this stock has made a nice little U formation, nice recovery from the lows that we made about 2 years ago. So I'm going to cover the stock chart to begin with. Then we'll jump into the most recent financials. I think those are kind of interesting. Then I'm going to compare them to Facebook a little bit, at least from a cost perspective. I think you'll find that really interesting. We'll look at just in general, just digital ad spending, see where this is trending. I think, as you all know, it's trending upward. And, you know, the last thing I want to do is actually compare Facebook to Google, to Pinterest, and to Twitter, because I don't normally do this, but these companies are all doing the exact same thing. They literally all have the exact same business model and they make money the exact same way. So in that case, it's a very, very pure comparison. So we'll take a look at that and we'll do some comparison there, which again, not something I normally do. Let's jump right into the stock chart. As we can see, we went public here about 3 years ago. This stock really sold off really nicely, very rapidly. A lot of bearish sentiment on this stock. A lot of people doubting their business model and doubting if they'll ever really penetrate that digital ad market and make a bunch of money. This stock traded all the way down under $5 a share. Now it's made a really nice run here. We had this COVID-19 low, which most stocks made back in March, right around that $10 mark. And it's boom, it's like almost all stocks has just absolutely exploded to the upside in the last 3 months. I personally have not bought a stock in about 3 months because just when stocks are ripping like this, you're supposed to buy low and sell high. I was buying back in March, but I just haven't been buying recently. So not to say that buying Snapchat at these current levels is a total ripoff, but obviously you'd like to buy them back when they were at these lower levels. So again, we're at a 52-week high here, and we're at a $33 billion valuation. 8% short interest is a little bit higher than most stocks that we've been looking at. I think the higher this stock goes, the more people will jump in here and short it, because it does have a fairly low, I think, you know, if it retests some lows, it could easily get down maybe into the $17, $18 range. But then if it breaks that, you're all the way back down to 10. So this stock does have some downside potential. I think upside, it's going to hit its head up on this IPO price. I think you probably have a lot of investors looking to sell when it gets up into this range. We'll see what happens. Not saying that I'm guaranteeing that's what's going to happen, but that's normally what happens when these stocks make this nice U recovery. As you get back closer to these all-time highs, it's going to be tough for this stock to break out, especially as we get this valuation stretched here. So let's jump into the financials. Again, we got a $33 billion valuation on this stock. We've got top line revenue here. I want to show you something interesting though. This is their 10Q. They start off with cash flows. And so Snap Incorporated wants you to judge them on cash flow. And the reason for that is because they have this $300 million net loss, which is almost identical to the year prior. They have most of it tied up in the stock-based compensation, which you could argue with any kind of investor out there. Look, you've got to pay your employees somehow. If Snap was not paying their employees with stock, they would have to pay them with something, either Bitcoin or cash. I don't really care, but it would have to be something. So stock, in my opinion, is cash. And then adding this back in, they get back to this $6 million worth of cash flow, which obviously looks a lot better than a $66 million loss in their cash flow the prior period. But again, I don't really pay attention to that because, yes, a lot of this net loss here is stock-based compensation. Well, actually more than half of it. But look, if they didn't pay their employees with stock, they'd have to pay them with cash. So I don't really care for that kind of analysis, and they're obviously leading off of that. What I want to get to is the top line, bottom line numbers, which we see here is actually pretty impressive. In 2019, they had $320 million. Again, these are in thousands, so this is 320 million, almost 321 million back in 2019. And this period, it jumped up nicely, you know, like that's like almost 50%. That might even be more than 50% growth there. up to, we'll call it $463 million. Now, cost of revenue is kind of interesting. That to me seems kind of high. We just looked at Adobe, we've looked at Facebook, we've looked at some of these other tech companies. This is actually pretty high from a gross margin perspective. Then obviously they have R&D, they have sales, marketing, general administrative. We get a total cost of $748. We see that's ticked up nicely from the period before, which was $636. So yes, we do have top line growth, but we have expense growth as well. That takes us to an operating loss of this $286 million. That improved just slightly. Notice, look, revenues jumped up really nice, but notice that operating loss barely improved. And by barely, it's about call it $30 million. That's a decent improvement, but that takes us to this net loss after you factor in some interest and other stuff. We improved just barely. So we went from 310 to 305. So this company, in my opinion, is still a ways away from break even. Okay. They're still a ways from making a profit because we saw that revenues jumped up by, nearly 50% here, and our net loss barely changed. So that means they're going to have to grow this revenue line by a lot. I'll let you do the math on there, but it is a lot. And if revenues keep jumping up 50% and this barely changes, it's not that in my opinion, not going to be that impressive. In terms of revenue, while revenue growth is impressive, we're not translating that into any kind of improvement on the profit line. Now, let's jump down to the balance sheet to see if they can withstand these losses, and absolutely they can, because they just IPO'd a few years ago, raised a ton of money. So they have, we'll call that $2 billion worth of cash here, and they have very, very little liabilities. Most of these tech companies do at this early stage. They don't really have any debt. They don't really, they've got this convertible note here, but they don't have a lot of messiness. Again, we have about 1.7 in liabilities, but we have this 2 billion in cash, and we have a total assets actually of this close to $4 billion. So this is a company from a balance sheet perspective looks extraordinarily healthy, but again, on a quarterly basis, and I think you can annualize this out, is losing quite a bit of money despite the impressive top line growth on the revenue. Now, what I did want to point out here was kind of interesting. So as I told you, cost of revenue, so we'll come back to this screen, I'll show you. So we have our revenue here of $462 million, but our cost of revenue, which you break this out, after you break this out off the revenue, you get to a gross margin. Notice that their gross margin's at this 55%. Now that actually went down. It was actually worse in the prior period. And so, that's kind of interesting to me, because what I wanted to do was take a look at Facebook. And so I'll come to Facebook. This is the same. This is Facebook's 10Q. This is the exact same consolidated statement of operation, but from a percentage basis. So this is 100% of revenue. This is a percentage of cost of revenue based off your revenue. So 55% of their revenue gets chewed up by cost of revenue. 52% of revenue gets chewed up by R&D. And you get to notice that total cost and expenses that's 162% because they lose money. So Facebook, on the other hand, this is what's really interesting. Look at their cost of revenue. 20%. That's basically half, even more than half of their cost of revenue. So Facebook's gross margins, now I know that Facebook's ad business and business in general is a lot more mature than Snapchat, and Snapchat could eventually grow into what we'll call maybe a 20% cost of revenue structure. But it's weird. To me, it's weird that it's still really this high for a company that, is not necessarily in its late stages, but it's a relatively mature company. Snapchat has been around for a little while. We see research and development's only 23% of cost. It's 52% over at Snapchat. 16% of Facebook's costs are marketing, 26% over at Snapchat. General administration's only 9% at Facebook, and they've got tons more employees. Look, it's 29% over at Snapchat. So Snapchat, you can look at this two ways. You can look at it glass half empty, glass half full. They're either going to improve these numbers and it's going to translate into a bottom line, eventually turn into a bottom line profit or turn this bottom line around, or they're not going to be able to turn it around. They're just bleeding money in these ways and they can't get efficient like Facebook has, and they're never going to turn it around. I don't know what the answer to that is. I just found it interesting that Facebook has really dialed in their cost structure, and some of it has to do, again, with how long Facebook's been around versus Snapchat, how long their ad product has been around versus Snapchat, and just the overall size of the company. But it does bring up some alarm bells. But again, if you're bullish on Snap, it could bring up opportunity. You could say, well, hey, look, these numbers are going to start to level out or go down because that's what Facebook has done. I don't know what the right answer there is. Just wanted to point that out to you. Now, digital ad spending worldwide. Now, the first thing I want to do is bring up revenue. So here's revenue, and I've got Facebook, Google, Snapchat, Pinterest, and Twitter. And again, all these companies play in the same ballpark. We'll look at trailing 12 months. Whenever you see TTM in terms of financials, it's trailing 12 months. So wherever you are on the calendar, it's basically that month and 12 months prior. So if you're in January, it's the last year. If you're in March, it's from March of this time last year to this year. And so notice, okay, Google and Facebook, obviously, are the behemoths here. And if you add this up, I guess that's 200, we'll call that 200. We'll just call this close to $250 million that those two companies are generating. And if you come here to 2019, notice we're at $300 million. So Google and Facebook are gobbling up the vast majority. Again, I said that those two companies are about $230 to $250 million of digital ad spending based on financials that we have. And look at this, digital ad spending worldwide is $300 million. That leaves barely $100 billion worth for other companies to divide up. Now, I know that's a lot of money, but notice how this gradually gets up. And we're going to get to $500 billion by 2023. And you could argue whether or not it trends up in this direction, but I would argue that this is probably the case. But I think what you could also argue is that Google and Facebook are going to gobble up the vast majority of that. And companies like Snapchat, Pinterest, Twitter, Yahoo, Bing, Microsoft, they're going to get I don't want to call it scraps, but they're going to get the leftovers, okay? The bulk of the money and the revenue in the digital ad spend, at least in the foreseeable future, is likely to go to Facebook and Google. So I think you want to keep that in mind with Snapchat. Now, we saw on Snapchat's chart that the stock has performed very well since jumping off the lows. So I'm not saying you can't buy this stock and make money, but you really need to pick your spots because this is a stock that can, as fast as it's gone up here, it can definitely go back down because it's not going to be a market leader. And you can see it representing in this graph. We've got Facebook here. This is impressive. Google's even more impressive. Look, I've got Snap, Pinterest, and Twitter. That just gives you kind of a perspective on these companies compared to these just in terms of revenue. Now, top line growth. Obviously, Facebook and Google are the behemoth. It's almost like comparing me to like Michael Jordan or LeBron James in terms of basketball skill. Obviously, those guys are going to be way, way more impressive playing basketball than I am. I mean, I think that's fair comparison there. So, but Snapchat, Pinterest, and Twitter, let's check out their growth rate. So here we've got a revenue growth rate. This is forward. So we're actually looking forward. This is kind of based on forward guidance. Now, guidance can change at any time, especially when you got COVID-19, some uncertainty there. But I think these companies will be relatively close to accurate on these. We see Facebook, on terms of revenue growth rate, still really impressive looking. And these are in percentages here. So Facebook's looking to grow revenues this year at 19, call it 20%. That's really impressive. impressive. Google's going to grow at 14%. That's still really impressive considering how large I just showed you they were. Now, Snapchat, this is where some of the excitement around the stock and maybe where investors, bullish investors, kind of make their argument is Snapchat actually of all these companies is growing the fastest. They're going to grow their revenues, they say, by 35% in the next, call it 12 months. Pinterest is growing really fast too. They're at the 30% mark. Now, Twitter kind of lagging it. And I think you could almost look at Twitter stock too. It's probably lagging in terms of recovery. And it's because they're only looking to grow their revenue by about 9%. Now, I don't normally look at metrics like this, price to sales, price to earnings. I honestly believe if all it took to be a great investor was to look at price to sales and price to earnings and price to book, every single one of you would be rich and wealthy. If that's all it took is to look at some ratios that you learn in Finance 101 and say, oh, I'm going to buy it when it's at 6 and I'm going to sell it when it's at 15. If that's all it took to be a great investor, every single person in the world would be a great investor because it'd be that easy. But in this case, I think since we're comparing companies that are all their sales are almost identical. Okay. All these companies, they don't take money from the users. They all take money from online advertisers. So it gives you a really good view on how these companies are their valuation. So Facebook's only selling at 9 times sales. Google's even better at 6 times sales. Okay. Now compare that to Snapchat. Snapchat is what I would consider, at least in comparison, very richly. I mean, it's almost twice Facebook. It's almost 3 times Google sales. Okay, yes, I know the revenue growth rate is impressive, but if you take down to Pinterest, Pinterest is not very far behind Snapchat in terms of revenue growth rate, but in terms of evaluation, they're only trading at about 10 times price to sales, whereas Snapchat's up at the 17. So I really think Snapchat is really kind of outpaced itself. And as we see, Twitter here is kind of also down low here at the 7 times forward earnings in terms of price to sales. So that's another stock that I think is going to lag the market as well. Now, okay. What would I do with Snapchat? Okay, the stock has had an incredible run, but I want to give you a little bit of philosophy here, guys. So as we look at these revenue numbers again, what I like to do, and this is not saying you need to do this, I'm just saying what I like to do. I like to invest in companies that are capable of winning the gold medal. When you look at this, imagine this is like Olympic athletes right here, okay? These are the Olympic athletes that are either swimming or running or whatever the competition is. And here's their past performance right here. So Google and Facebook are clearly the best athletes, the best condition. They are chances of winning gold are super high. Snapchat, Pinterest, and Twitter, their odds of winning a gold medal are almost 0 compared to Google and Facebook. Can they win the silver medal? Can they win the bronze medal? Sure. But did Yahoo win? How did Yahoo do winning a silver medal in search? How did BlackBerry and Nokia do winning a silver and bronze medal in the cell phone market? You can go on and on. How does Under Armour do winning a bronze medal compared to Adidas and Nike and maybe even Lululemon? Just go look at those stocks. They are absolute trash stocks. So again, I'm not saying that that's going to happen to Snap, Pinterest, and Twitter because the overall trends in their market is actually pretty good, but so is Under Armour and so is search engines, okay? Typically in stocks, there is 1, maybe 2 winners. And I think in the digital ad space, I think we're going to have 2 winners. Now, that's not to say Snapchat stock can't go down and go back up. But in my opinion, this is not a long-term 10, 15, 20-year hold stock. Now, if you bought it down here at 5 and you want to sell it or put your stop loss in as it gets up here in the 20s, I got no problem with that. But if you're thinking about buying and holding Snap, especially if you're a young kid, I just don't see it because I think Facebook and Google are going to win the gold medal. They're going to gobble up the vast majority of this revenue, and they're going to leave the scraps to companies like Snapchat, Pinterest, and Twitter. And while those companies' stocks might perform well during periods of time, I don't see them as long-term holds. And we just saw this company is going to lose money this year, probably going to lose money next year. and they've got a value at over $33 billion. And from a comparison basis, it's actually not that great, at least from a price to sales. From a dollar for dollar perspective, you're paying up huge for Snapchat in comparison to all these companies, but especially the market leaders, Google and Facebook. Now, this is not an endorsement to just go out and run out and buy Google and Facebook, but you can take it for what it is. Now, full disclosure, I'd like to add that I have considerable amounts of shares of Facebook and a little bit of Google. I think I only have 1 or 2 shares of Google. And by considerable, I mean based on my portfolio size. I think with Facebook, I might have 20 or 30 shares. I'd have to go back and look, but I know for a fact with Google, I think I only have 2 shares of Google. So you can keep that in mind. My handful of shares that I own in each of these companies is certainly not market making, but I've never bought Snapchat. I've never bought Pinterest, never bought Twitter. I've never even thought about it because I tend to like to focus on the companies that I believe are going to win the gold medal. And I think in the digital ad space, without a doubt, it's going to be Facebook and Google. And from a valuation perspective, at least on a price to sales basis, much more attractive than any of these other companies. So hopefully that helped you out. Again, hit that subscribe button. If you made it all the way through this video, give me a shot. Check out some of my other videos. Hit that like button. Leave me a question. Leave me a comment. Maybe you disagree with me. If you got a stock you'd like for me to cover here on the channel, please leave that comment below. I'll get to it as quickly as I can. I'll be honest, I've got about 20 to 25 stocks in the queue. I'll be getting to them as fast as I possibly can. That was Snap Incorporated. Hopefully you guys enjoyed it. Good luck with your investments.